Good afternoon and welcome to this week's Halftime Talk, where every week we take a moment to a deep dive discussion on the topics impacting the global energy markets. We're honored to be joined today by Mr. Mike Muller, the head of Vitol Asia, recently appointed as president and CEO of Vitol's operations in Asia. Mike, welcome and congratulations.
Thank you very much, Sean.
Mike, let's start big picture today. We're looking at sort of coming out of the two quarters, the second and third quarter, 6 months of the COVID pandemic. The energy markets have made all sorts of volatility, with WTI famously going minus $40 in April. But ultimately, as we sit here at the beginning of the fourth quarter, I'm wondering, all the things you've learned, you've seen over the last months, how does it set you up for planning for the Q4 trading into 2021 with this pandemic now seem to be with us for a while?
Thanks, Sean. Yes. Let me just start off by saying that I do have a tendency to speak about many matters enthusiastically, and I know this pandemic has been more than an inconvenience for some. With the million+ deaths out there, some cases have been a lot closer to home than we really would have wished, and we probably all know loved ones who fall in the high-risk group of people for whom perhaps only the arrival of a vaccine will be some sort of respite and relief. So my condolences do go to any listeners who have lost friends or families this year. So it's always tricky to say how do we build on learnings and move forward into next year, but it is that time of the year, it is that time of the annual planning cycle when we have to cast our minds ahead to what strategic decisions we, the participants in these energy markets, need to take in order to learn and derive some sort of advantage for our shareholders, stakeholders, and for our customers from what we saw this year going into next year. But at the end of the day, we need to put pen to paper on agreements on whether to continue with relationships and whether to forge new relationships and so forth. So if your question is, what are the takeaways? My goodness, many momentous events have occurred during the pandemic, but many have occurred before the pandemic as well. It's been such an unprecedented year. So the biggest takeaway, I guess, is this. The market knows how to respond to surprises that it has seen before. It knows how to deal with Hurricane Delta that we have upon us, crossing through places like Playa del Carmen in Mexico tonight. It knows how to respond to military escalation in positions of sanctions, even terror attacks, all that field of hostilities the market has dealt with. So we had a lot of Middle Eastern headlines dominating headlines in the 5 months before the initial COVID outbreak in Wuhan, such as the not yet fully investigated attack on the Khurais and Abqaiq facilities in Saudi Arabia, attacks on vessels in the Gulf of Oman, tightening of sanctions relating to Venezuela, the big spike that caused the VLCC markets when COSCO fleet was temporarily sanctioned by the US, the attack on Qasem Soleimani, and of course the on-off status of US-China trade relations. I mean, I can go on and on and on. And I've certainly missed a few there, but the world knows how to respond to those. It does not deal that readily with uncertainty. Now, of course, we have seen a virus before. It was SARS, and to a smaller extent, the Middle Eastern variant of it, MERS. And the market knows what impact this can have on economic growth. But SARS was contained to South Asia, as the name suggests. And I recall seeing in late January, early February, I guess, that this crisis that had put Singapore in the number 2 spot globally for virus cases had a threat of going global. And let's remember that the price in January was still $71.75 Brent.
Seems like another lifetime ago.
It does, yes. Then we had, let's come to the learnings, because you're asking me what sort of lessons we've derived. But it was only as recent as March that we had Saudi Aramco, who were obviously in IPO mode, delivery mode. A new oil minister, Crown Prince Abdulaziz bin Salman, appointed only as recently as September last year, looking to reassure their investors in the markets that they could produce steadily at above 12 million barrels a day. We had those famous production test days in March when the virus was already coming west. But they were fulfilling their plans to reassure the world that they could be a stable supplier. 12.7 million barrels a day, I think, was the number. And Abu Dhabi, in a smaller way, was doing the same with their test that they met at 4 million barrels per day. All that after the falling out with Russia, which saw shocking timing coincide, if you like, because the virus had already started eating into confidence. So what are the three takeaways? Let me pick a few here. Number one, OPEC Plus as an entity is intact and critical to today's oil price. We got the price war that I spoke about, but there has been cohesion because common sense prevailed. And whilst the target prices of various players in the OPEC Plus entity may not be the same, their objective for now has been fulfilled. As I said in one of our recent webinars last Sunday, mission accomplished in terms of US production. Look at what happened to US output, which was pushing 13 million barrels a day late last year. It's now down at 11 or so, and that's not because the US is part of the OPEC Plus agreement. It is pure economic forces. So that's number one. Number two, I think the virus market conditions have accelerated debate on the energy transition and of the role of traditional players in the future energy landscape. So the pace of change was accelerated by recent declarations such as BP Week, offering all these scenarios of theirs, each one of which suggested that peak oil demand is right now. And whilst this is a view that many in Asia cannot personally reconcile with what they see in terms of Asian growth, which clearly lies ahead, and not just in Asia, other parts of the developing world like Africa, it is becoming increasingly inadvisable, indeed pointless, to contradict or challenge prognoses, where the bigger point is that we all need to do our bit to urge the world, the global economy, into action to curb the threat posed by global warming. Statements such as peak oil demand is surely somewhere beyond 2030 is something that we can leave to consultants like you, Sean. But indeed, the world is going to need a lot more electricity and a lot more non-oil commodities in the metal space to build the lower carbon society that is required by the Paris Climate Agreement. So has the virus accelerated the likelihood of a set of global rules and standards helping with this? It's very difficult to say. Has the virus dented political odds like Trump's chances of re-election? Possibly. But what is clear is that the international energy firms that we used to call the oil majors certainly need, with their much dented market capitalizations, need to continue to play a role in leading the energy transition. I mean, we have BP stock lower than it was after Macondo. We have a company called Next Era that many may not have heard about, a large power producer from wind and solar energy, etc., and gas, of course, in Florida, making headlines being a bigger market cap than ExxonMobil. Does it feel right? Does it feel right that ExxonMobil don't belong in the Dow Jones Industrial Average Index, which they fell out of 2 months ago? I'm not so sure. But what I do know is the inside of one oil major where I worked for 29 years, and I do know that it is grossly unjust to see some observers generalize or speculate that these companies are not fit to walk the talk when it comes to leading the energy transition. Shell not only has world-class project delivery capabilities, it has world-class and sincere leadership who definitely mean what they say when they talk about safety and the environment. So I'm convinced that people grabbing headlines out there, writing off such companies, such great companies, and the role they will play in their transition are going off-piste. We are in a cyclical business. So that's my third point. The market always reverts to a balance because market forces are at play. And even with the OPEC Plus overlay, we have a market which has to balance out. And this is the main statement I think that I took away from one of your former interviews in this Halftime Talk series, Mark Moody-Stewart, board director of Aramco, but also longtime CEO of Shell, who said that invariably markets will have to align themselves with the cost of the lowest cost producer, of course, signaling that the advantage does lie with NOCs who have low cost resources. But I've been asked many times this year whether OPEC Plus and even core OPEC will survive in that context, will survive 2020 intact. I think we have the answer to that question if we look at US crude production levels, which have dipped, as I said earlier, from 13 to around 11. But history has shown many, many times that the investment cycle is very often out of sync with the price cycle of the underlying commodity, and fueling speculation that the current phase of underinvestment by the majors, referred to by many, including the Rosneft speaker at last week's FT Commodities Forum, for example, as potentially $500 billion to $1 trillion over the current down cycle of underinvestment. This is invariably going to bite, even in a world where we may have seen peak oil demand. So it is quite plausible that oil prices could be a lot higher than this.
Let me just jump in, Mike, and ask. Yeah, I just want to follow up on the OPEC Plus point that moving forward again to how to trade the markets into the fourth quarter in 2021 does, I think, rest a lot on where you forecast OPEC Plus to go in their solidarity around their current supply agreement. There are a number of laggards, as the word has become the standard industry term. I think it's a sort of rough word, but nonetheless one will use. So the compliance, while has been good, there's been notable exceptions. And I'm wondering, can this hold together if OPEC Plus needs to revisit the decision to increase production in January because demand is not there to meet another 2 million barrels of OPEC Plus oil? Can they hold this group together under those circumstances, do you think? And how do you trade that?
Okay, the 2 million barrel per day planned resumption of production is probably one of the biggest planned changes in production that the world will have ever seen. And as such, I don't believe the market sees it happening in one fell swoop. It's becoming increasingly clear that demand projections are disappointing and that the world may not see the fragile recovery return volumes of demand to the market at the pace that maybe was felt to be the case 1 or 2 months ago. As such, I think the smart money in the market is already anticipating that OPEC Plus will revise that 2 million barrel per day change in supply to market from the 1st of January, either to a later date or perhaps phase it over a number of months to try and tune it in line with demand. But of course, there's a lot of time to go between now and the point where they need to reach that decision. January OSPs would be announced about 2 months from now. January trading cycle will start just over a month from now, and term contracts for 2021 will need to be cast in stone about a month from now as well. So in the month that lies ahead, we will have a few more indicators from the demand side of the equation, but also we'll have a slightly better feel for how much supply has been suppressed by these low prices. And I cannot overemphasize the point that at 30-something dollar WTI and low 40s Brent, and occasional dips as we saw last week into the 30s for both, it is not economic for fracking crews to be deployed in all but the most prolific basins in the shale world in the US and other parts of the world also. And this is going to see the underlying decline rates that kick in when you underinvest or don't invest in established oil fields take substantial amounts of production away, and OPEC will have to form a view on that. But yeah, in short, I personally do not see 2 million barrels hitting the market on January the 1st.
Okay, and with that then comes the question. I was just going to say, with that.
Sean, to answer your.
Go ahead.
Just to answer the other side of your question, is there any threat to the cohesion of the OPEC Plus club? It's all about balancing budgets and whether the economies, the countries that form part of this club will feel sufficient pain on the domestic front in terms of the local economy to break rank or to feel that they can no longer hold their end of the bargain. In the very short end of the spectrum, we've seen accusations flying around about certain members of that club. Iraq has been in the news, various West African countries have been in the news, being asked to fall in line. The market has broadly congratulated Crown Prince Abdulaziz bin Salman and OPEC leadership for bringing these guys into line by granting them more time to compensate for overproduction, possibly unplanned, and to play catch up, which is still playing out now. And on the whole, the market is observing a renewed discipline amongst some of those countries, such that it is congratulating OPEC on compliance. In the longer run, however, the big question is, can some of these countries make do with a $40 price? And the answer most observers would have given you in the past is no. But we have the overlay of economic hardship caused by virus lockdown conditions and other things, which in some ways makes it worse and maybe shortens the tolerance span to months rather than years on how many of these participants can cope with $40 oil. But on the other hand, it also gives their governments a very convenient and valid excuse with potential unrest in their populations, where they're going to have to make the inevitable cuts to domestic budgets. So my personal view is this club is not likely to break apart anytime soon.
So there lies the sort of next question, which is, depending where these things go, how does it impact the direction of travel on a balanced inventory levels? We see obviously the well above the 5-year average, which is generally acknowledged to be the industry standard. What is your outlook for the direction of travel towards the 5-year average on inventories? We've had all sorts of different views over the last few months on how quick or slow that will happen. How do you see that through the coming quarters, and do we get to balance at some point, do you think?
So indeed, let's just map out what's playing out. I mentioned before that demand hasn't been rising anywhere fast. In fact, it may well stagnate. So the recovery in supply-demand fundamentals is being driven primarily by supply being taken off the market, as we discussed. And OPEC Plus are playing a huge role in that, but non-OPEC, the economic forces suppressing investment and suppressing completion of wells is also playing a very, very large role in that. So if we were to oversimplify and say that next month's demand is the same as this month, which is plausible, although I personally think it is still rising, and you're taking something like 5.7 million barrels a day supply off the market compared to the 2019 average, which is the OPEC baseline, or let's just pick another number, 3-4 million barrels per day overall, less than it would have been otherwise. That means you're going to see something in the order of 100 million barrels of inventory disappear every quarter, right? 100 days times, 100 million barrels disappear, I beg your pardon, every month, or 300 million barrels disappear every quarter. That's going to take us leaps and bounds towards the 5-year historical inventory average. And of course, historical averages should be better expressed in days covered because, of course, we have a lower demand world, although that demand is primarily focused in on one product, which is jet fuel. As diesel and gasoline demand recovers close to 2019 levels. So what are OPEC trying to achieve? OPEC Plus are trying to create a backward structure in the market where they eliminate the inventory build up at the front of the market, which is weighing down on sentiment and ultimately drives flat price. Unfortunately, we're going through a wave of that not happening because we have, as an industry, seen the initial demand recovery accelerate out of the April lows through May, June, and July. And people projected that growth would continue. And of course, we may not have factored in things like the impact of floods and bad weather in large Asian economies. We may not have factored in the fact that after people drive on holiday during school holidays, that driving stops. And as such, the demand slowdown has caught a few people by surprise. What happened is that refineries drew away at the inventories, especially on the water. We have definitely observed inventories of crude oil floating on the water drawing down quite substantially. But putting those through refineries and creating products which are now potentially moving into surplus as the world was taken by surprise by the absence of demand. But the bigger picture remains that the energy complex is driven by the input, which is OPEC Plus and non-OPEC supply of crude. And that is unabated at the levels OPEC Plus set out. So whether the surpluses ebb and flow from crude to products and what that means for refining margins, which we may talk about a little later, is all part of the supply-demand gyration equation. What really matters here is that OPEC discipline has restrained supply to market and that globally inventories are drawing, not necessarily in the places where we see them through transparently available data in OECD, but they certainly have been drawing. That is the big picture. And I think we may see a bit of a speed bump ahead because the market has returned to contango in the benchmark grade. Brent is printing 50 cents contango or thereabouts. That coupled with very cheap freight rates has incentivized people to put oil on tankers again. The data, of course, won't come through because we trade a few weeks ahead. So in data coming through later in October, early November, we may see on-the-water stocks build, which goes against what OPEC Plus are trying to accomplish. The smart money will anticipate that because they see it, but it may not make for good optics going into November. And therefore, it may be some time before we go back on the path of drawing those inventories visibly so to get towards the 5-year average. And the 5-year average translates to a backward market where prompt supplies trade at a higher price than forward numbers. At the moment, that is not the case.
A lot of that also in terms of the where one might see that we've talked about the supply side and how that can be managed in order to keep or move to a balanced market. But also on the demand side is the big question of China. And over the third quarter, the second quarter, the general tone was, wow, China's importing at record levels. and with that, the price recovered, one of the reasons why. I'm wondering your outlook. How do you trade the China data now, going into the fourth quarter, going into the first quarter, and what's your outlook for that?
There are many things to say about China. Absolutely stunning recovery from the virus, which of course hit China about 2 months earlier than much of Asia and perhaps 3-4 months ahead of the rest of the world. But the bounce back from the Q1, Q2 lows in China caught many by surprise. And that bounce back wasn't just in energy demand, it was also in demand for other commodities such as metals. The economy was motoring on many accounts. But there are many qualifying statements there. We have to remember that for much of Q3, China was free of virus lockdown restrictions when many economies that would compete with China in the international marketplace for manufactured goods and labor-intensive goods such as, let's say, textiles and what have you, would have been in lockdown. And therefore, this gave China extra demand as the global economy was dragging on goods through Amazon and DHL and Alipay, etc. China was the, if you like, the breadbasket of the world's mail order system. And as various economies, through policy decisions such as India, come out of lockdown, even whilst the virus has not been eliminated, that restores a balance. I think it's also fair to say that China had a massive economic incentive to build commodity inventories. Look no further than oil for the evidence why. The domestic pricing system favored refiners importing oil when the price of oil was below their domestic prices, and refining margins were artificially great in China. We've talked about this in many of our weekend seminars, so I won't go into too much detail, but the other factor not to be underestimated is China's launch of commodity indices. And the INE futures contract provides for delivery from multiple coastal storage facilities in China. And because the open interest in this contract was building during 2020, there's quite a lot of stock build going into those facilities where there are economic incentives to hold storage and charge your receivers a pre-agreed storage rate, which is higher than international storage rates and therefore incentivizes stock building. At the same time, of course, we must not forget that data in China is not as transparently available as it is elsewhere in the world. And that's in part due to the fact that there's such a rate of construction of new tank farms and new refining capacity, which means that it is very hard to draw parallels between stock changes in a place like Singapore, the US, Europe, and in China.
We're seeing in the China sort of annual cycle, a sort of seasonal slowdown, if you want, that we would expect to build up into the new year ahead of the Chinese New Year. We're just on a big holiday in China this week. It looks like 500 million people on the move, staycation. What's your sort of outlook for that trend? Do you expect demand in China, imports to sustain at these levels that we saw in the third quarter into the fourth and the first?
It's hard to predict, but yes, as China emerges from Golden Week, everyone is expecting a resumption of crude purchasing because the Chinese imports of crude are governed by quotas, and those quotas, in the case of many independent importers, would appear to be exhausted. And as such, people are waiting for the January quotas to kick in. As I said a little earlier, we're going to start trading December FOB oil in less than a month's time, and therefore that's not long after the return from Golden Week. And at that point, everyone is expecting accelerated buying. Let's not forget, China refines 14, 15 million barrels per day, the vast majority of which is imported. So China has not stopped buying. Just because the independents have run out of quota doesn't mean they're not drawing on inventories or buying from people who do have quotas. That said, the buying has not been at the same levels as it was for a large part of Q3, and there's no doubt in my mind that it will resume. It's just a question of when. Of course, we still have a big question mark around the buying for strategic purposes. Chinese global crude oil inventories, last time I looked, were in the high 900s millions of barrels per day. And any new refinery that comes on, like Rongsheng, Hengyi, for example, and other refineries belonging to the larger established SOEs, requires a stock fill, and that stock fill is something that will automatically add to those inventories. The final thing, which is the most visible of the lot, is the queue of yet to discharge VLCCs and smaller tankers waiting off Shandong. And that number in the VLCC count peaked at 62, but it is very difficult to translate that into what is going on inside China, because these VLCCs often don't discharge in one hit. Many of the independent refiners have limited credit and therefore will take a little piece off of VLCC and then it goes back to anchorage. So that number of 62 seems to have moved down into the low 40s now. And for the first time in recent days, we've seen a decided down move in that queue of ships, which many people will see as a precursor to the buying that I talked about earlier, which will resume after Golden Week. It's just a question of whether it resumes immediately after Golden Week or whether there's some tactical waiting and it doesn't happen until later in October or even November.
Let's just wrap up quickly, Mike, on refining. Clearly, refineries have been through a very difficult period. They still are. You mentioned in your comments there about China, a lot of new refining capacity coming on in China, over 4 refineries, 1.5 million barrels, I believe, of extra capacity on the way. Where do refiners go? How do you see the outlook of that into Q4, Q1?
Yes, I'm afraid the market for refining has been grim. I mentioned the ebb and flow of surpluses moving from product to refined products, depending on refinery utilization. And we have a big warning sign in terms of forward margins, which historically always gravitate towards the historical mean. And if you look at the forward curve on all cracks combined or a synthetic forward margin, it is not doing that. It is plateauing at levels much lower than historical means, which is telling you that marginal refining capacity is not needed. And of course, we know what's causing that. The world has been running at levels that are way below global refining capacity, and the refining capacity mentioned in China is being added to by major projects in the Middle East, namely the Al Zohar refining complex and the Clean Fuels project in Kuwait, and Jazan in Saudi Arabia, all of which will ramp up through 2021. So the world has to live with the fact, which is that it has excess refining capacity. Now, many refineries have been limping along at capacity rates of 70-75%, but there's a huge change in the world order of refining, because in the past, complex refineries with high Nelson complexity indices would tend to run at full, whereas the marginal capacity that was taking the hit was simple refined capacity. A combination of two things, IMO giving a huge value boost to very low sulfur fuel, and jet fuel not being the product in demand, has flattened out the playing field. Whether you look at Saudi OSPs, where Arab Heavy is roughly the same price as Arab Extra Light giving you more jet, Arab Heavy giving you less very low sulfur fuel oil, or whether you look at complex refineries backing off in the same way as simple refineries. It's a very, very interesting new world order there. But the reality remains that refineries are looking vulnerable, and those that are not competitive, high cost, or disadvantaged by handicaps such as having disadvantaged draft or the penalty of congestion in berths, or in some cases simply lacking the protection of government subsidies and tariffs, will find it hard to make ends meet and will continue limping along at levels that will not give their shareholders anything to smile about. And it is no secret that some refineries have already announced that they are going. So in Japan, we've seen the Osaka refinery owned by ENEOS with a minority shareholder there, PetroChina, close, which is the last one in a long, long trend of Japanese refineries closing. And it is no secret that costs are higher than Japan than anywhere else. You've seen Shell announce the closure of their Tabangao refinery, which is in fact 2 refineries, one of which hasn't been running for some time anyway, but that looks like it's a fait accompli. In the West, you have Total closing the Grand Prix refinery near Paris. So inevitably, there will be more of these because it is not sustainable for refineries to continue running at these levels if we don't see a return in demand of jet fuel. And many observers are saying that jet fuel demand is something that may not come back, vaccine or not, for quite some time yet.
Well, Mike, that seems like the place to finish the interview. Thank you so much for being on this week's Halftime Talk. And again, congratulations on your new role as head of Vitol Asia. Best of luck with the journey. It's certainly exciting times, if nothing else. And, have a good week, be safe, and we'll catch up with you soon.